In this session, we'll be talking about a small article written by Rene Schulz, which talks about the governance aspects, the risk management, and the risk taking in banks. So, to what extent a bank takes risk? What is the optimal level of risk for a bank? How does governance play a role in the risk management process? What is the objective of risk management in bank? All these things. So just to get into the agenda, a key things that are covered as a part of this article is what are the different methods that are used by banks to really determine how much of a risk they should really take. Right? On what factors? What are the mechanisms typically engaged by the banks to understand how much of a risk they need to take? And what if they take more than that optimal level? And what if they take a risk that is less than that optimal level? What are the implications of that? And we are going to talk about, yes, a bank is implementing effective risk management. But what are the structural challenges and limitations to it? And in general, one of the major tool with which risk mitigation is done is by setting different kinds of limits. So whether it is trading limits or lending limits or whatever. So what are the real problems that come with limits? And we talk about a few things like governance, and we'll be talking about risk culture. How would they really impact the risk profile and the performance of the bank? So let's get started. Now, first of all, what is the role of risk management in a bank? We all have to understand and accept the fact that any business, including a bank, one of the major objective is, or probably the only major objective is, shareholder wealth maximization. I hope all of you are with me on this. Right? The only objective of any business is the shareholder wealth maximization. Now, what is the role of risk management? How is it really facilitating this process? So when I am talking about a role, I need to know what is the function, organization, what is the power of risk management, how much has to be spent for it, and what are the tools and techniques that are used to perform this. And the main objective is to ensure that the risk management as a role is really making sure that the wealth of the shareholder is maximized. And let's understand the fact that this risk, the word risk, has different kinds of implications for different kinds of banks, because different banks have different kinds of businesses. Probably there could be one bank which is just making loans or just making deposits, versus there is another bank which is heavily into different kinds of transactions, right? So the risk levels of this bank is completely different from the risk levels of these banks. When you look at a bank that is making just a loans and is financed with equity, not much of a borrowing. Now what matters is the positive NPV to the loan. That's it. And the risk of the entire loan portfolio may or may not be looked at the first outset itself. So the objective of the risk management is it should definitely create value. And when it creates value, then only the shareholder wealth maximization occurs. And when does risk management create value for a bank? One, it has leverage. There is a debt. If it is all equity kind of a bank, then there is no question of risk management. So, because banks operate with a high amount of leverage, if they take a calculated risk management, they can really gain value out of it. So, the first objective, the first and foremost thing when risk management creates value for the bank is, first of all, it should have enough leverage. And in general, if at all value and wealth have to be created, they are created through low risk liquid liabilities. By liabilities, the borrowings the bank has done should be low risky and liquid borrowing. Whenever it wants, it should be able to borrow for short term periods at almost negligible cost. And remember, if that has to be low risk, probably the assets of the bank should be less and less riskier. If the bank is very highly risky, if the operations of the bank are heavily risky, so it can't produce low risk liquid liabilities. So they have to, in order to get into this aspect, they have to manage the risk of the asset, the loans that they are making, they have to really manage those loans so that the low risk liquid liabilities are produced which can improve the value of the bank. And to what extent the bank gets into what kind of business will typically determine what is the optimal level of risk the bank can take. So if it is highly deposit based bank, probably there is a different kind of risk level. And if it is heavily transaction based kind of bank, then the amount of risk level that it has to take is completely different. In general, if they take too little risk, okay, there is an optimal level every bank is determining based on its business operations. Now, if it is taking lesser risk than that optimal, mean bank is very conservative. It's not taking the full abilities of its capabilities. So all the positive NPV projects also it is turning them down, which could really impact the value of the bank. So it is having an impact on the value of the bank. But at the same time, if it is taking more risk than what it is really required, then because the bank is becoming too risky, probably it is losing business. When things are not going in the way, the bank is losing business very badly. So it's always advised that every bank has to determine the optimal level of risk that it is supposed to take, and based on that optimal level of risk, take the action accordingly. If the relationship between the risk and the value is concave, means the probably it's like this. Up to a certain amount of risk, the value is, so when I'm looking at value, it is this way. So the value up to a certain amount of risk, the value is increasing, increasing, increasing. At a certain point, it's maximum, and after that, it is decreasing, which is an indication that this should be the optimal amount of risk that the bank needs to take. So this is what I'm calling out a concave relationship between risk and value. That particular level of risk that maximizes the shareholder wealth. And we all need to understand the fact that that particular level, if the CEO can understand without much of a cost, everything is resolved. Everything is working fine. But we need to know that in many cases, CEO is not the person who is taking this kind of decision. It is purely based on the different kinds of activities that are executed by different employees across the bank. Now, this is where identifying this level of risk is always a tough thing, and that is what will drive the bank towards meeting its objectives more effectively. Now, whatever is the risk management process that is implemented by the banks, the main objective of it, we all know, first identify the risk, come out with appropriate measures for the risk, aggregate the risk. Similar risk needs to be aggregated. Action plan has to be implemented for each of the risks. And finally, the monitoring on a regular basis, the different action plans that are implemented, what is the effectiveness of each of the action plans. So when you are saying a risk is good, it's a positive NPV project on a standalone basis. Now, if I look at it in theoretical sense, any project that it's giving me a positive NPV, I should be able to take that project. But again, the bank may not be able to take all of them, because the more and more such kind of projects they take, because of more and more such kind of projects, the bank will become more and more riskier. Because one NPV project on a standalone basis, fair enough. But if I am talking of multiple NPV projects, then again the capital requirement also will be very high, and if it has to borrow that much, the bank is becoming too risky, which means it can't accept all those positive NPV projects. And on the other hand, when I am saying bad risks, they are the ones which are zero and negative NPV kind of projects. So individually, if you look at, they are going to reduce or destroy the shareholder wealth. But what you have to understand is, within the bank, there could be incentives to the management to take risks that do not create any value to the shareholder. Independently or isolatedly, it may not create any kind of a value, but to some people, there could be some kind of an incentive to execute this project, a pet project of the senior management. So even if it is a negative NPV project, they would like to go ahead and implement this particular project, which means there is a risk, and in some cases the risks are costly also. If all the risks are costlessly observed and measured, then there is no question of risk management at all. Firm can invest only in limited resources, and that is where risk is inevitable, and risk management plays an important role. So every company has to invest in risk management. Probably when you look at from a perspective of a safe bank, there is no point in taking too much of a risk. More risk it takes, more cost it has to incur. But if it is taking less risk, obviously there is no big cost to it. But on the other side, if I am taking a risky bank, for it, how much of a risk it has to take? It can't take too little a risk, but at the same time it can't take too much of a risk as well, because if it takes something different from its optimal level, there is a big loss for that bank. And at the same time, there is some kind of a strong incentive, if at all it can identify the right amount of risk. Now this is where a bank has to decide what should be the right amount of risk that it has to take. Then, for everything as a risk mitigation process, we talk about setting limits. But what is being argued by René Schulz in this article is, we don't have a theory of limits. Whenever things go wrong, we say that more limits should be there, more granularity should be there in the limits. For each separate activity, we should set limits. So that is what is the discussion that always comes up. And when the more and more you are becoming granular in setting the limits, there is a chance that you will lose out all your positive NPV projects. So the limits in typical also, they can't control the risks that are not observed and that are not measured. So you are setting a limits. For what are you setting the limits? You are setting the limit those which you can observe, those particular risks which you can measure. For them you are setting the limits. But what about the other risks which you are not able to measure, which you are not even able to observe? How are you really controlling those kind of risks? Even the limits cannot control the risk where risk management is not allowed to put limits. So there is such kind of a limitation that exists with respect to limits, especially like strategic risks. Banks don't put any kind of a limit on the strategic risk that they are taking, right? So every risk management activity, even if it is good, it's not that it's a kind of a panacea for all the activities of the bank. I'm sure there are going to be material losses. So you can't eliminate all the bad risks here, not feasible and even not economically sensible also to eliminate all the bad risks. And you can't monitor even all the risks in such a way that the material losses are not possible. There is going to be a material loss. That is where a calculated risk taking is very, very essential from every bank's perspective. So the major objective always about a good risk management plan is make sure that the bank is operating at its optimal level of risk. Identify what is the optimal level of risk for the bank based on the business and make sure that the bank is not taking too much of a risk than that, nor it is taking too little a risk compared to that. And couple of activities of the bank also will have an impact on the overall risk profile and the performance of the bank. Look at the governance aspects. So typically two major things that need to be focused on regarding the governance. What is the level of independence? Right? Is it acting independent of the business units? Or how close the risk management function is to the business units? Then CRO functioning. Is the CRO completely independent of the business or CRO is tightly packed with the business? And there is always a trade-off for both these things. If they are too independent, there could be something. If they are very less independent, there could be some other complication. Similarly, CRO, if he is completely alienated from the business, there is a different implication. CRO is closely related to the business, then again the implications differ. Look at these two things if I am looking at from the perspective of a simple risk management. Too close to the business, probably the assessment is getting more and more biased. Correct? They will be influenced by the business heavily. But if it is too remote, too much delineated from the business, can't even make out what is going on and can't facilitate the risk management process. So which means it's a kind of a trade-off that every bank has to get in. What should be the typical role of the CRO and the risk management function? How much it should be independent from the business? Should it be too close to the business? Should it be completely delineated from the business? So that's one aspect which will have an impact on the risk profile and the performance of the bank. Similarly, look at the incentive structure. The performance evaluation of the employees, in general can't be based on the profitability that is being generated by a particular business. It has to consider the risk that is being taken by the employee to accomplish the result. So, a typical economic capital based approach of measuring the performance, which is a risk adjusted return based measurement approach, really makes a lot of difference, right? You have to figure in the risk while measuring any kind of a return. So that's where the risk adjusted return, RAROC kind of approaches, they typically play an important role in doing the performance evaluation. So incentives, they cannot adjust for risks that the risk manager is not able to observe and is not able to measure. Correct? Incentives are being targeted only for the risks which you are able to observe and which you are able to measure. But what about those risks that are unobserved? Right? So when risk is not measured properly, even the incentives also will fail. Now this is where risk measurement becomes very important, and that will definitely, whatever the incentives you are setting, they will be definitely effective only when the measurement process is more and more effective. Then coming to the next important aspect within the bank, which is the risk culture. Whenever you have to define the word culture, it's a kind of shared values which clearly define what should be the attitude, what should be the behavior for the various people in the organization. So it's a kind of a norms and values which talk about the attitudes and behavior of the employees in an organization regarding the risk. So basically when I use the word risk culture, it all talks about what is people's perception about the risk. How do the employees really view the risk here? So what is the kind of interaction the employees at the business level are having with the risk manager? Any bad news that comes up, how is the organization communicating it and dealing with it? What is the process that is employed by the organization? All these are a reflection of the risk culture within the organization. How quickly the top management is learning about a change in risk and how quickly they are acting to it. Now, let's understand that not everything can be written down. In some cases, active management of the risk is very much essential. And that's where the risk culture plays a very important role. Right? So, whatever the processes that you have put in place, in some cases, they can't remove the impact of behavioral bias, and in some cases, even the conflicts of interest cannot be removed. So, all these things really play an important role in terms of the risk profile and performance of the bank, which have to be handled with efficiency to really produce value out of the risk management process. So this is what the article talks of. The summary is also telling you whatever we have covered during the last half an hour or so. So in case you have any further queries regarding this, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.